Something just snapped in the silver market, and if you blinked, you actually missed it. We're talking about a 21% reversal in barely 24 hours. Silver collapsed from roughly $121 all the way down to the low 70s. And then it ripped right back toward $90 in Western spot pricing, almost 12% in a single session on February 3rd. That's not a slow recovery, that's a shock. And here's the part that should grab you right now. The real trigger wasn't demand disappearing, it was forced selling. Stay with me because I'm going to show you what actually happened, why it matters right now, and how you can spot this pattern before the next crowd does. If you're holding silver, if you're watching precious metals, if you're trying to understand what just moved faster than anything we've seen in years, your job is to understand the mechanics behind this move, not the narratives, not the headlines, the actual structure. Before I explain what caused this whiplash, let me teach you something most people never really understand about markets. Prices don't just move because people change their minds. A lot of the time, prices move because people are forced to act. Think of leverage like driving on ice at high speed. Everything feels fine until you tap the brakes. Once margin requirements rise, or volatility spikes, traders don't choose to sell. They have to sell. It's not optional, it's mechanical. When you borrow money to amplify your position, you're making a bet that price will move in your favor before the exchange forces you out. But here's what happens. The moment volatility explodes, exchanges raise margin requirements to protect themselves. That means if you were holding a position with, let's say, $10,000 of your own capital and $90,000 borrowed, suddenly the exchange says you need $15,000 backing that position instead of 10. You've got minutes, maybe hours to come up with that cash, or they liquidate you. And when that pressure finally releases, prices don't politely recover. They snap. That's the foundation you need to understand what you're seeing in silver right now. Markets move on forced action way more often than people realize. It's not always about fundamentals changing, it's about who's forced to exit and when that pressure runs out of steam. So, what does that tell us? It tells us that the most violent moves often aren't about new information. They're about leverage unwinding, and the snapback, the recovery you're seeing right now, that's not necessarily irrational exuberance. It's what happens when the forced sellers are done, and there's nobody left who has to sell. That shift from mandatory liquidation to voluntary positioning, that's where you get these explosive reversals. If this is making sense so far, drop a comment below and let me know if you've ever been caught in a margin squeeze before, because this lesson applies to every leveraged market, not just silver. Now, here's what's actually happening under the hood. Last week's crash from $121 to around $71 wasn't led by a collapse in physical demand. And that's the critical detail everyone needs to understand. Shanghai pricing stayed closer to $95 to $100 even during the panic. That divergence matters. It matters a lot. Western paper markets, the futures contracts, the ETFs, the derivatives, they were hit with margin hikes and cascading liquidations. So when prices fell, accounts got squeezed, stops got triggered, and selling fed on itself. One sell order triggers another, which triggers another. It's a cascade. That's the primary driver of what you saw. It wasn't fundamentals. It wasn't a change in industrial demand. It wasn't mines suddenly flooding the market with supply. It was mechanical selling pressure in the paper market. Then comes the secondary effect, and this is where it gets interesting. Once that forced selling runs out of fuel, once every account that was going to get liquidated has been liquidated, shorts start covering. Think about it. If you're short silver and you just watched it fall from 121 to 71, you're sitting on massive profits. But you also know that when forced selling ends, prices tend to bounce. So you cover. You take your profit. You exit your short. And that covering, that's buying pressure. At the same time, margin pressure fades because volatility starts to calm down. Suddenly, there's nobody left who has to sell. All the weak hands are gone. The leveraged long positions that couldn't meet margin calls, they've been flushed out. And that's when prices jump. That's when you get these violent reversals that confuse everyone who's only watching the headlines. But here's the part that should make you pay very close attention. The paper price didn't lead the physical market back up. It had to chase it. Western spot silver is now racing to close the gap with Shanghai, not the other way around. That's convergence, and convergence is powerful. When paper and physical realign, when those two markets that diverged start coming back together, momentum traders pile in. Algorithms flip from sell signals to buy signals. Sentiment changes fast, really fast. And here's the part most people are missing, and it should make you a little nervous in a good way. Once a market proves it can move 20% in a day, it reminds everyone how fast it can move again. That memory doesn't go away. Traders adjust their position sizes. Risk managers widen their stop losses. Volatility expectations reset higher. And that creates a different trading environment going forward. Now let me show you what very few people are talking about. The Shanghai physical market held significantly higher than Western paper during the crash. Why does that matter? Because it tells you that physical buyers, the people who actually want to take delivery of metal, they didn't panic. They didn't suddenly decide silver was worthless. What panicked was the leveraged paper market, the futures traders, the speculators who were using borrowed money. And when you see that kind of divergence between physical and paper, between real demand and financial speculation, you're getting information about what's structural versus what's temporary. The structural demand didn't collapse. The temporary leverage did. And when leverage unwinds but demand holds, you get exactly what you're seeing now, a snapback. This is the exact same playbook we've seen before, and I want to walk you through the history because pattern recognition is everything in markets. In 2011, silver crashed under liquidation pressure and then rebounded violently once that pressure cleared. If you were watching precious metals back then, you remember this. Silver had run from around $18 in late 2010 all the way up to nearly $50 by April 2011. Then came the margin hike cycle. The CME raised margin requirements 5 times in 8 days. 5 times. Traders who were comfortably positioned suddenly couldn't meet the new requirements. Forced liquidation kicked in. Silver fell from nearly $50 to around $33 in a matter of days. That's a 34% drop. And what happened next? Once the liquidation pressure cleared, once the weak hands were flushed, silver stabilized and then rallied back. It didn't go straight back to 50. Markets don't work that way, but the rebound was sharp, and it confirmed that the crash was mechanical, not fundamental. Same pattern we're seeing today. In March of 2020, during the global liquidity freeze, silver got absolutely smashed. You had the COVID panic. You had margin calls across every asset class. Silver fell from over $18 down to nearly $12 in about 2 weeks. Physical premiums went through the roof because dealers couldn't get supply, but the paper price kept falling because of forced selling. Sound familiar? And what happened once the forced selling ended and central banks flooded the system with liquidity? Silver surged. It went from $12 in March to nearly $30 by August. That's a 150% move in 5 months. The initial rebound wasn't the end of the move. It was the reset. It was the market clearing out the weak positions and re-anchoring to underlying demand. Every time this has happened, and I mean every single time, the initial rebound wasn't the finale. It was the opening act. When you zoom out, you see the same rhythm. Leverage builds during a strong trend. Everyone's feeling confident. Positions get bigger. Then a shock hits. Could be a policy change, could be a margin hike, could be a liquidity event. Doesn't matter what the trigger is. Weak hands get flushed out. The leveraged positions that can't survive the drawdown, they're forced to exit. And then price re-anchors to underlying demand. The larger story is that these events don't end trends. They clarify them. They separate the speculators from the real buyers. They reset sentiment. They create new entry points. And if the fundamental thesis is still intact, the trend continues, sometimes stronger than before, because all that weak positioning is gone. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be a dead cat bounce? Absolutely. Dead cat bounces are real. They happen when an asset falls so hard that it gets a reflexive bounce purely from technical oversold conditions, and then it rolls over and continues lower. Could broader risk markets roll over and drag silver down again? Of course they could. If equity markets crash, if there's a credit event, if liquidity dries up across the board, silver's not going to be immune. And no, this doesn't mean prices go straight to $150 or $500 without pain. Markets don't move in straight lines. They never have, and they never will. Anyone who tells you they know exactly where silver's going next is either lying or delusional. But here's the thing about manipulation or conspiracy claims, and you hear a lot of these in the precious metal space. You don't need them to trade or understand this. You really don't. Focus on what you can control: price behavior, market structure, key levels, support and resistance zones, volume patterns. Those tell you far more than narratives ever will. Does unusual trading happen in precious metals markets? Yeah, probably. Do large players sometimes push prices around? Sure. But you can't trade based on conspiracy theories. You can trade based on observable patterns. And the observable pattern here is forced liquidation followed by price recovery. That's not a theory. That's what happened. You can see it in the price action. You can see it in the divergence between Shanghai and Western markets. You can see it in the volume spikes. The data's right there. There are probably 3 types of people watching this right now, and I want to talk to each of you directly. The first is you. If you got shaken out during the crash, maybe you were holding physical silver. Maybe you were in a leverage position and you got stopped out or margin called. You feel frustrated, maybe even angry. You're watching the price recover and thinking you should have held on. That's a completely normal human reaction. But here's the lesson for you, and it's an important one. Position sizing and understanding leverage. If you were forced to sell, it means you were positioned too large for the volatility in this market. Forced liquidation doesn't care about your conviction. It doesn't care if you're right long term. It only cares whether you can meet the margin call right now. So the lesson isn't that you were wrong about silver. The lesson is that your position size or your leverage didn't match the reality of how violently this market can move. Take that lesson forward. It'll save you in the next high volatility event. The second type is you if you stayed in and rode it out. You held your physical metal, or you had enough capital to weather the margin calls. You're relieved right now, maybe even vindicated. You're thinking you were right to hold on. And you know what? You probably were. But your job now is not to get euphoric. Euphoria is dangerous. It makes you overconfident. It makes you size up too big on the next move. Protect gains and respect volatility. Just because you survive this drawdown doesn't mean you'll survive the next one if you get complacent. Set levels where you'll take some profits. Set levels where you'll reassess the thesis. Don't marry your position. Stay flexible. The market's rewarding you right now, but it can take that away just as fast if you're not careful. The third type is you. If you're watching from the sidelines, thinking you missed it. You saw silver at $71 and you didn't pull the trigger. Now it's back near 90 and you're kicking yourself. Here's what I want you to understand. You didn't miss it. These structures unfold over time. This might be the first leg of a bigger move, or it might not be. But either way, there will be another entry point. There always is. Your edge is patience and preparation. Study what just happened. Understand the mechanics. Build a watch list of levels you'd be interested in, and wait. Chasing price after a 12% move in one day, that's how you get caught buying the top of a bounce. Let the market come to you. And the universal principle for all 3 of you, regardless of where you are, is this. Violent moves are information, not just price. When silver moves 20% in a day, it's telling you something about market structure. It's telling you about leverage levels. It's telling you about where the weak hands were positioned. It's telling you about the gap between paper and physical markets. That information is valuable. Use it. Don't just react emotionally. Analyze it. What does this move tell you about how this market works? What does it tell you about who the participants are? What does it tell you about what levels matter? So here's where I stand, and I want to be clear about this. I'm not blindly bullish, and I'm not dismissing risk. I'm focused. First, I'm watching whether $85 to $90 holds as a launch zone. If silver can hold above that range, if it can consolidate there and build support, that tells you whether this rebound has legs, or if it's just a temporary bounce before another leg down. Price action in that zone over the next few sessions is critical. Second, I'm watching the $95 to $100 area because reclaiming Shanghai parity confirms alignment between paper and physical. If Western spot can get back above where Shanghai was trading during the crash, that's a strong signal that the divergence is resolving and the markets are agreeing on value again. Third, I'm watching $70 to $75 as the invalidation level. If price breaks back below that range, if it takes out the lows from this move, the thesis changes. That would suggest the rebound was just a dead cat bounce and the forced selling might have more to go. You need invalidation levels. You need to know what price action would tell you you're wrong. Otherwise, you're just hoping, not analyzing. Let me tell you what I think is really going on here based on the structure of this move. This move was mechanical, not emotional. It was driven by margin pressure and forced liquidation in the paper market, not by a fundamental change in silver's supply and demand picture. The fundamentals didn't disappear. Industrial demand is still there. Whatever thesis you had about monetary policy or inflation or currency debasement or mine supply, none of that changed between $121 and $71. What changed was the leverage structure in the futures market, and now that leverage has been flushed out. Now you've got a cleaner market with fewer weak hands. If the fundamental thesis is still intact, and I think it is based on what I'm seeing in the physical market, then this washout might actually strengthen the next move higher, because you don't have all that leverage waiting to unwind again. If history rhymes, and it usually does in markets, the snapback you're seeing now could be the opening act, not the finale. Could be the start of a re-acceleration in the trend once the market confirms that the forced selling is done. But I'm not making predictions here. I'm not telling you silver's going to 150 or 200. I don't know that, and neither does anyone else. What I'm telling you is to watch the structure. Watch how price behaves at these key levels. Watch whether the physical and paper markets continue to converge, or if they diverge again. Watch for follow-through. A single day's bounce doesn't confirm anything. You need to see sustained buying pressure. You need to see higher lows. You need to see the market building a base. I'm not a financial advisor. This is not financial advice. Everything I'm showing you here is education and analysis, not a recommendation to buy or sell anything. Do your own research. Verify what I'm saying against your own analysis. Make your own decisions based on your own risk tolerance and your own financial situation. I'm just showing you how I'm thinking about this market and what I'm watching. You need to decide what makes sense for you. If you made it this far, you're the type of person who wants to understand how markets actually work, not just follow headlines. That mentality will serve you well. The people who take the time to understand market mechanics, who study historical patterns, who focus on structure instead of just noise, those are the people who develop an edge over time, not because they can predict the future, but because they can recognize patterns and manage risk intelligently. That's the real skill in markets, not prediction, pattern recognition, and risk management. If this analysis helped you understand what just happened in silver, hit that subscribe button and turn on notifications, because I'm going to keep breaking down these market moves as they happen. Share this with anyone who's trying to make sense of the precious metals market right now. And drop a comment below. Tell me, were you holding through this crash, or were you watching from the sidelines? What levels are you watching next? I want to hear what you're thinking. Stay sharp out there. Think critically, verify the data, and make your own decisions. I'll see you in the next one.